The dollar's below the November highs. That's a bullish catalyst for risk assets. There's absolutely no doubt in my mind about that.
Was it a bearish catalyst just last week or the week?
Yeah, that's exactly, yes.
All right. Things just chopping around, whipsawing left and right.
All right, I'm just saying, if we're below those highs, look out. Hey everybody, and welcome back to Pardon the Price Action. I am JC Parets, and as always, I am joined by Steven Strazza. Steve, let's get right into it. So first, we are getting a little movement in credit spreads lately. What is the bond market telling us right now?
So whenever we talk about bonds, I mean, credit spreads are really top of mind. We're getting a little bit of movement in them past few weeks, I would say. One way that we like to look at credit spreads is basically the inverse. We're looking at bond prices instead of the actual yields. You're going to get the same picture. It's going to show you what's going on with credit spreads if you look at something like high yield bonds relative to treasury bonds. The first chart shows just how correlated that ratio is with stocks, right? That's why it's important. That's why we're looking at it. When credit spreads move, they tell us about, the likely direction of the stock market. Now, the ratio is basically driven by the numerator, which is high yield bonds, because they're higher beta. And what this chart is showing you is exactly that. It's HYG IAI plus HYG. What we're saying is if high yield bonds, HYG, break down on an absolute basis, the writing is on the wall for credit spreads to move higher. What do you think?
Yeah, no doubt about it. I mean, listen, for me, when I see the deterioration in something like this, it calls my attention. When I'm seeing some of the OAS credit spreads sort of widening, you're seeing some of that stuff in Europe too, European credit spreads with the German Bund. To me, it catches my attention because this happens simultaneously with risk coming out of the market, right? When you see that stress in credit, you've seen it in the relative strength in staples and in utilities. And you have seen certain areas of the market, not broad markets, but certain areas of the market get hit really hard. So it's popping up a little bit on there. So definitely something to monitor. But again, sometimes it's leading, sometimes it's coincident. So right. It's not like such a reliable leading indicator, which leads us back to, if we're going to be analyzing price, great, the bond market is a great supplement to the price analysis we're doing in the stock market, but we're going to defer to what's happening in stocks if that's the question, right?
Sure.
All right.
Ready for Baltic Dry Index?
Go for it. Give it to me.
The Baltic Dry Index has really collapsed since late last year. What are you making of it?
Man, you asked me. It's funny because you asked me, and you could see how oil and the Baltic Dry Index are moving together. And you send me this chart. You're like, hey, what do you think of this? And I'm like, honestly, until like a year and a half ago, I hadn't heard the words Baltic Dry Index in over a decade. So it's not really anything I was really thinking about for a long, long time until we started really moving and started moving higher with oil, and it started becoming part of the story. But the truth is, I don't know what it means. If you're asking me, should we be buying or selling crude oil because of what this is doing? That's not for me. We're buying oil. If it's above 84, we're buying oil stocks, energy names, like that's a leader. We're not going to fight that trend, regardless of what the Baltic Dry Index is doing. That's what I think about that.
I couldn't agree more. I think it's an interesting chart. It has really moved together, crude oil and Baltic Dry, and then you really are seeing them dislocate a lot in recent months. But again, if you look at that chart, this relationship has diverged or dislocated plenty of times in the past, and that could be happening again. What the Baltic Dry
lumber?
Yeah, it's similar to lumber. It's basically like a leading economic indicator, the Baltic Dry.
It's similar to lumber in the fact that it ain't for the faint of heart. That's how it's like lumber, right?
I mean, it really moves. I mean, the index went from 4,500 back to 1,300 today. And if you're looking for a way to trade something like this, they do have an ETF for it, BDRY. We cover it in our commodities report each week.
Boom. And like I said, if you're wondering what to make of this information and you're trading oil, just stick with the price of oil. That's what I think makes the most sense in all of this. But fascinating nonetheless, never a dull day. Mr. Strazza, new lows for IPOs. A record number of companies came public over the last few years. Will these IPOs ever stop going down? Here we're looking at the Renaissance IPO Index Fund.
I mean, listen, the IPO market was red hot. We set a record in 2020 for most IPOs, and I think we beat it in 2021. A lot of companies that people have been talking about coming public for years finally came public, this cycle, the past few years, whether it's something like Robinhood, WeWork, Coinbase, Rivian, Airbnb, all these big name kind of startups. These are storied startups of all time, definitely of recent history. And pretty much every single one of them, when you go down the line, has done nothing but go down since coming public. It kind of feels like, we're getting close when you look at some of these charts, but we need to see it first. We got some nice candles on Friday. You could see it in the Rivian chart. We need to see more. We got some follow through today. Let's see what the rest of the week brings, right?
Yeah, today, first day of the week, as we're recording this on Monday, definitely some follow through from last week, at least one day into the week. And this IPO index is really, we talk about it, it's just a great gauge for that particular segment of stocks, smaller cap growth stocks, mid cap growth stocks, growth in general, really, just that whole premise. I think the IPO index does a good job of capturing that. You can also throw in like the ARK funds, biotechnology, even Chinese internet, throw it in there, marijuana, crypto, you could probably mix in there. Started seeing deterioration in the first quarter last year. The NASDAQ advanced decline line all peaked around that time. So that's all one story in a nutshell, in my opinion. And the IPO index does a great job of capturing that. Really, really does.
It's the speculative stuff, right? It's the growthy stuff that's coming public.
But not so much speculative, because there's other speculative. There's speculative oil and gas stocks that are doing great, right? Those are not right.
Right. It's the long duration
assets
or growth stocks. Really.
And then the further down the risk curve you go in that particular segment of risk, the more they've gotten beat down, right?
Absolutely. Further down the cap scale you go to. So bears?
Yeah.
The bears are finally coming out of hibernation. We're getting some extreme readings from our sentiment indicators. Is this it? What do you think?
We've been monitoring it for quite some time, and the question was, has sentiment unwound or is sentiment unwinding? And the answer through last week had been clearly sentiment is still unwinding. That's what we're seeing now. But think about, here we're looking at both individual investors and financial advisors combined, and we haven't seen this this few amount of bulls since 2016, since summer 2016. I remember like it was yesterday. I was one of those bears, and I converted around that summer after that initial rally that didn't roll over and we held in. People are the most bearish since then. Yeah. Like that's a long time ago. That's before COVID. So even during COVID, people were less worried.
So there are fewer bulls now than COVID, just to be clear.
That is correct. Much fewer than COVID. Fewer than the December 2018 lows also, by the way. Which
you got to go back.
Scary time. I remember I was roasting a pig down in Miami the day the market bottomed. You see how it's like, it takes you back. Like when you hear like a song, it takes you back to high school or reminds you of a friend or some girl or some party, right?
I'll never even forget just a few years ago, Christmas Eve, when stocks bottomed. Things were crazy going into Christmas Eve, I guess 2018.
I think that's what I'm talking about. That was the day we roast Cubans. We roast pigs on Christmas Eve, right? See?
When we look at indicators like this, we're just talking about the IPO index, whatever, put call ratio, whatever you want to look at, it feels like we're getting close. These are a lot of things that you tend to see at bottoms, right?
All right, let's talk about these wicks. Mr. Strazza, long shadows or wicks are a sign of indecision. Yeah. We've seen a lot of this lately. What does it all mean?
Right. So real quick, just candlestick 101, you have the real body, which is the rectangle, and then the lines coming out the top and the bottom is really just showing you the range of that day or whatever the candlestick period is. We're talking about daily charts for purposes of this. So when you see long wicks, whether it's a long upper wick or a long lower wick, you call them shadows, that's telling you, the stock traded in a wide range that day, showing you where it came from. Might have closed, somewhere in the middle, but, was at the lows of the day. It's showing you that buyers and sellers were battling it out at that level. It's a sign of indecision. And if you compare what we're seeing right now, I use the Dow as an example. We're seeing in Dow futures a lot of long, lower, and upper wicks. We had a similar situation at the COVID lows. There's an example of the NASDAQ 100. So I think, like I said, we're getting close. What is this, 6 days of just indecision, these long-legged dojis or long-legged candles, wide. It's something you see at bottom. So it's something I'm keeping an eye on. What do you think of it?
It is something you see at bottoms and something you see at tops too. When you see that indecision, in a lot of cases, you can argue that these are maybe like bear flags, right? In downtrends. And let's just say that is what you're saying, right? That's not necessarily how we interpret it, but let's just say that you interpret it that way, like this is a bear flag. In other words, this is just a consolidation within an ongoing downtrend that should continue in the direction of the underlying trend, which you would presume is to the downside. Let's just say you believe that, fine. But if we break out from here, then that invalidates that thesis, and that is in fact a reversal, which these dojis, these long-legged candles are essentially suggesting to me. So whether you're looking at it as a bottom and indecision that resolves higher, or you're in the bear camp and think that it resolves lower, either way, an upside resolution would be a bullish catalyst, regardless of which side you're on, right?
Right. And we see patterns fail all the time. And then, we've been having a lot of these like red to green, crazy intraday, periods. This is how they're illustrated through candlesticks, right? When you get one of those crazy red to green days or green to red days, you'll see some long-legged candlestick, a lot like these. So
no doubt. All right, let's play a little game.
So this is a game that we like to play where we say the first word that comes to mind. Today's word is polarity.
For me, Mr. Strazza, when it comes to polarity, I think simplicity. We complicate things and look at market breadth and intermarket relationships and the dollar this and interest rate that and Europe and emerging markets, and it's a never-ending, cycle of data that we go through.
Yep.
But what it all comes down to, what it all boils down to is polarity. It's resistance, overhead supply, where there's an overwhelming amount of selling pressure relative to buying pressure, and prices stop going up. That's a peak, whether it's a short-term peak or a longer-term peak. But no one can deny that there was an overwhelming amount of selling pressure versus buying pressure at that price, which is why prices fell. When we return to that level, we are met with similar overhead supply. And then when we resolve above that, when we return, that former resistance turns into support, right? That's what we call polarity, the polarity principle. So all of the things that we do really boils down to that one thing. So one word, simplicity.
Yeah. I think of horizontals, right? Like we talk about this a lot. We love drawing our support and resistance zones with horizontal lines. That's because when you draw a horizontal line, there's price memory. The security was actually transacted at that price at some point in the past. When you're drawing support and resistance lines with diagonals, the polarity principle doesn't play a role because there is no price memory in a diagonal trend line. So big difference, right?
Horizontal, I like what you did there. That was very JC of you. That's something I would say too. When I think of polarity, I think of that, we talk about trend lines. Like I prefer my trend lines to be horizontal, not diagonal, for the reasons that you...
Because of polarity, really.
I love it.
Yeah. 2-minute drill.
All right, 2-minute drill. The dollar has been one hot mess of a chart lately, and it looks like we could be getting another failed move at the recent highs. Where is the Dixie headed, and what does it mean for risk assets?
All right. It's been a really messy chart. Let's just talk about it. We broke out of this base in the dollar index a few months back, and we started flagging in what looked like a pretty tight bull flag. Looked like it was resolving lower, tested back to the base, then ripped higher last week and made new highs. Today, we then undercut those November and December highs and are now back in that little flat range. So we've been seeing moves fail in both directions. Maybe this fails too. But let's talk about what it could mean. First of all, when you look at the table, the returns for commodities have just been off the charts pretty much across the board. So it's a bull market for commodities. Okay. Commodities and the dollar have been rising together since like last summer. It's not something we want to make the bet that continues. That's not something we want to bet on. So we're expecting one to eventually reverse course. When we look at our equal weight commodity index, just broke out of a nice continuation pattern, making a leg higher. And then when we look at commercial hedgers positioning, they're super short dollars. They're super short dollar index, getting close to a record short. I think that all kind of bodes pretty well for a lower dollar, and then, you know, the related tailwinds that come with that for risk assets and commodities.
This is the chart you need to look at, my friend. This is it. JC's favorite head and shoulders tops are the ones that are not that at all and are actually continuation patterns. And if all of the things you said are correct, I mean, you're just stating facts. Commercial hedgers are super net short the US dollar index. They are super net long Aussie dollar. Here you go. And just what the Australian dollar represents with respects to risk assets, copper, base metals, emerging markets, to me, all of that is related. If the dollar falls apart and Aussie rips, and commercial hedgers are certainly positioned for exactly that to happen, you're going to get a ripper of a market of risk assets. And, you know, big question to me is, should we focus on the resiliency in crude oil despite a strong dollar, or should we focus on the dollar despite all of the strength in commodities? And I gotta tip my hat to oil and energy, just resilient strength in the commodity and in the stock market too. I think that's the leading indicator. I think Aussie rips. I mean, you have a well-defined risk. I mean, here's your neckline. As long as we're above that 70 level, let's just call it, you own Aussie, you own risk assets, you're short the dollar. By owning all those risk assets, you're indirectly short the dollar. You don't literally have to short the dollar futures like commercial hedgers are. By owning all those risk assets, you're short USD, in my opinion.
Yep. Makes sense. I mean, we got to see it, right? Let's see if we get some follow through to the downside in Dixie tomorrow. Want to see Euro kind of get it together. Odd is at a critical level. This has got to hold, bounce from here. So
yeah, above 70, the squeeze is on, and the hedgers are right.
Yeah.
All right. Final word. What are you leaving them with?
I'm going to leave you with something boring today. So we're seeing a change in character just in the overall primary trends of the market, right? So I like to look at the Russell 2000. I think it's the best representation of what the average U.S. stock is doing. That's why it looks a lot like the value line index. We are now below a downward sloping 200-day moving average. I don't use the 200-day to trade off of. I don't use it as trading signals. It's usually not on my chart. I've been putting it on charts lately because I want to know, are we below and is it downward sloping? It is. And that's just, I mean, Brian Shannon puts it best, right? Rallies below a declining 200-day moving average are not to be trusted. So that's now where the Russell 2000 is. Whether the other large cap averages follow or not, we'll have to wait and see. But you want to approach small caps with caution here.
Yeah, I mean, listen, it's a function of what type of market environment we're in, and no one's going to argue that it's a messy market, and that's what we're seeing, right? Flat to down 200 days. So that makes perfect sense to me. I'm going to leave you with something a little different. I don't think that people use Twitter as good as they should. And I know I have a little bit of a bigger following maybe, but it's not the point. You can have less following. I ask Twitter the best questions and I get the best freaking answers. You know, I had this oxtail situation where my broth was like ridiculously spicy. You couldn't even drink it. And then the meat itself wasn't that spicy. I'm asking around. Man, I got such great answers. When I'm like in Singapore, I'm like, where's the best chicken rice? You know, if I'm in a different country, I'm like, what's the best pub or where can I go? Twitter is so helpful for just life questions. Even Morgan, my wife, is like, hey, why don't you ask Twitter? See what they think, like when we're going somewhere. And I do, because she gets it. So she's curious too. So listen, I don't think people are using their Twitter accounts as efficiently and maximizing the value out of that as much as they should. And me too, by the way. I do the best I can, but you know, I'm still improving. I've been in this game a long time in this whole Twitter thing.
You're pretty good at it.
I've learned a few things over the years.
I mean, you make a great point. It's really powerful, especially like you said, when you're going new places that you don't know really well. People are from everywhere on Twitter. So, hey, where can I get sushi and wherever? Perfect. So did you get some good tips for how to make your oxtail sauce?
Yeah. And I tried it already. I have dinner tonight waiting for me, but I already tried it because I couldn't help myself. And man, I crushed it. It's so good. It's ridiculous. So good. All right, guys, listen, thanks for watching. Make sure to give us a like, hit the subscribe button so you never miss an update. Follow me at All-Star Charts on Twitter and follow Steve at Strazza. Leave a comment below. Let us know what you think, and we will see you next week.